If you are collecting Social Security right now, the IRS already has 3 specific pieces of information about your account, and millions of Americans are making a financial mistake every single year because they do not know what those 3 things are or what they mean for their tax situation. This is not a warning about fraud. This is not about someone stealing your information. This is about a completely legal, completely automatic information sharing system between the Social Security Administration and the Internal Revenue Service that has existed for decades, and that is quietly costing people on Social Security hundreds and in some cases thousands of dollars every single April because they do not understand how it works. By the end of this video, you will know exactly what the IRS already knows about your Social Security, why that information can trigger a tax bill you were not expecting, and the 2 things you can do right now, before the next tax season, to make sure you are not overpaying the government money you legally do not owe. Stay until the end. The second thing I tell you is the one most Social Security recipients never do, and it is the only thing that prevents the surprise tax bill from showing up in the first place. If you are not subscribed to this channel, do that right now and turn on the bell. The rules around Social Security and taxes change every single year. When they change, neither SSA nor the IRS sends you a personal explanation. This channel covers exactly what those changes mean for your specific situation before tax season arrives. Subscribe and let's get into it. Here's what the IRS already has. Every January, the Social Security Administration automatically sends the IRS a document called the SSA-1099. You receive a copy too. It arrives in your mailbox or is available in your My Social Security account online. But whether you look at yours or not, the IRS receives theirs automatically. There is nothing you do to trigger this. It happens every year for every Social Security recipient in the country. The SSA 1099 contains 3 specific pieces of information that the IRS uses when reviewing your tax situation. The first piece of information is the total amount of Social Security benefits you receive during the year. This appears in box 5 of the form. This is the number the IRS uses to determine whether any of your Social Security income is taxable. The second piece of information is the amount of Medicare premiums that were deducted from your Social Security payments throughout the year. This matters because in some cases, those premiums can be deducted on your federal tax return, but only if you know to claim them, and only under specific circumstances that most people never check. The third piece of information is any federal income tax that was already withheld from your Social Security payments during the year. If you had taxes withheld, this amount is credited against what you owe. If you did not have taxes withheld, and most Social Security recipients do not, the IRS knows that too. Now here is where the mistake happens. Most people collect their Social Security check every month and treat the full amount as take-home money. They budget around it, spend it, and then in March or April they sit down to do their taxes and discover that a significant portion of what they received was taxable income, and they now owe the IRS money they already spent. Here is why that happens and exactly how much of your Social Security can be taxed. Social Security benefits are not automatically tax-free. Whether your benefits are taxed and how much depends on something called your combined income. Combined income is a specific calculation that the IRS uses. It is your adjusted gross income plus any tax-exempt interest income you received, plus exactly half of your total Social Security benefits for the year. If you are filing as a single person and your combined income falls between $25,000 and $34,000, up to 50% of your Social Security benefits are taxable. If your combined income is above $34,000, up to 85% of your Social Security benefits are taxable. If you are married and filing jointly, those thresholds shift slightly. Combined income between $32,000 and $44,000 means up to 50% of your benefits are taxable. Combined income above $44,000 means up to 85% of your benefits are taxable. And here is the detail that most people do not know, and that makes this problem worse every single year. These income thresholds have not been adjusted for inflation since 1983. They are the same numbers today that they were over 40 years ago. That means every year, as Social Security benefits increase with cost of living adjustments and as other income sources grow, more and more retirees cross these thresholds, often without realizing it, and find themselves owing taxes on their Social Security for the first time. What counts toward your combined income is broader than most people assume. It includes your Social Security benefit, yes, but it also includes pension income, withdrawals from a traditional IRA or 401k, part-time work income, rental income, capital gains, and even tax-exempt municipal bond interest. If you have any of these income sources alongside your Social Security, there is a real chance a portion of your benefit is being taxed and you may not have been setting money aside to cover it. Now, here is the specific mistake that millions of Social Security recipients make every single year. They do not request voluntary tax withholding from their Social Security check. The Social Security Administration allows you to have federal income taxes withheld directly from your monthly benefit automatically before the money ever hits your bank account. The form that sets this up is called the W-4V. It is a voluntary withholding request. You choose a withholding rate of 7%, 10%, 12%, or 22%, and SSA deducts that percentage from your payment every month and sends it directly to the IRS on your behalf. This one step eliminates the April surprise entirely. Instead of collecting your full benefit amount every month, spending it, and then discovering in the spring that you owe taxes you no longer have the money to pay, you pay as you go throughout the year, your tax obligation is settled automatically, and the amount you owe in April is zero or close to it. The vast majority of Social Security recipients have not filed a W-4V. They are collecting their full monthly payment with no withholding, building up a tax liability throughout the year, and then either scrambling to pay it in April or unknowingly underpaying and facing penalties on top of the original bill. Here is exactly what to do. Step 1, calculate your combined income for this year. Take your adjusted gross income, everything you earned or received that is taxable, not counting Social Security, add any tax-exempt interest income, then add exactly half of your total Social Security benefit for the year. That is your combined income number. If you are single and that number is above $25,000, some of your Social Security is taxable. If it is above $34,000, up to 85% is taxable. If you are married filing jointly and that number is above $32,000, some of your benefits are taxable. If it is above $44,000, up to 85% is taxable. Step 2, if your combined income puts you in a taxable range, file a W-4V with the Social Security Administration. You can download the form directly at ssa.gov or pick it up at any Social Security office. Fill it out, choose your withholding percentage, and mail it or bring it in person to your local SSA office. You do not file this form with the IRS. It goes to SSA. Once SSA processes it, your monthly benefit will be reduced by the withholding percentage you chose, and that withheld amount will be sent to the IRS automatically throughout the year. When April comes, your tax bill will already be largely or fully paid. If you are not sure what withholding percentage to choose, start with 10%. For most Social Security recipients with moderate outside income, a 10% withholding rate covers the tax liability on their benefits without over-withholding. Step 3, check your SSA-1099 from last January. Box 5 on that form shows your total net Social Security benefits for the year. Box 6 shows any federal tax already withheld. If Box 6 is blank or zero and your combined income puts you above the taxable thresholds, you have been underpaying throughout the year and you need to file a W-4V before the next tax season begins. You can access your SSA 1099 at any time by logging into your My Social Security account at ssa.gov. If you do not have an account, create one. You will need your Social Security number and a valid email address. One more thing. If you are in a situation where your income was temporarily high in a previous year due to a property sale, a Roth IRA conversion, an inheritance, or any one-time financial event, and that high income is now causing Medicare to charge you an IRMAA surcharge on top of your standard Part B premium, there is a separate appeal available. The form is SSA 44. You file it with SSA, show what your current income actually looks like now that the one-time event is behind you, and the surcharge gets reduced or eliminated. People are getting $200, $300, and $400 a month back from Medicare by filing this one form, money that was being deducted from their Social Security every month based on income they no longer have. Here's the summary. The IRS receives your SSA-1099 automatically every January. It contains your total benefits received, your Medicare premiums deducted, and your tax withheld, or the fact that nothing was withheld. If your combined income exceeds $25,000 as a single filer or $32,000 as a married filer, some of your Social Security is taxable. If it exceeds $34,000 or $44,000 respectively, up to 85% is taxable. The mistake most people make is collecting their full monthly benefit without withholding and then discovering in April that they owe taxes they already spent. The fix is the W-4V, one form, filed with SSA. Withholding starts the following month. Download the W-4V at ssa.gov today. Calculate your combined income. If you are in a taxable range, file the form before the end of this month. That one step eliminates the April surprise, permanently, automatically, for every tax year going forward. Share this with one person you know who is collecting Social Security and has never set up tax withholding. That one conversation could save them from a tax bill they were not expecting and money they no longer have. I will see you in the next one.